Would you like to know when and how big banks and institutions like Warren Buffett buy and sell? Would it help you if I could show you what this looks like in a real-world case study? This case study will help you conceptualize supply and demand and will form the foundation on which Module 2 is built on. We're going to look at a case study focused on where to buy and sell, and we are going to finish this off by summarizing our findings. The financial markets are dominated by institutions, investment giants like asset management firms, hedge funds, and banks. To understand their influence, consider this. The top 15 largest asset management firms now hold a combined total of 55 trillion in assets under management. To put that into perspective, if you were to spend $1 million every single day, it would take you more than 148,000 years to spend $55 trillion. This staggering amount of capital gives these institutions incredible power to move the markets, dictate trends, and dominate liquidity. But how does this impact you as a trader? Market movements are driven by institutions. Institutions aren't trading small amounts. They are moving billions at a time. Their decisions, buying, selling, rebalancing, create significant price movements that shape the market. Smart money versus retail traders. Retail traders often have limited information and resources compared to institutions. Understanding how smart money operates is essential to positioning yourself effectively. Module 2 teaches you to identify and follow institutional footprints. The Blueprint program equips you with the skills to identify and trade alongside these institutional moves, leveraging their power instead of fighting against it. Let's head into a case study that is based on a real-life stocks example, which will show us why supply and demand matters. But this is important. Don't be mistaken. This is not only applicable in stocks, it's applicable across all asset classes, stocks, futures, and forex. So let us inspect this chart for a second. Where's the optimal spot to have bought this stock on the chart? Exactly, right here at the bottom. Now, what do we know about this spot with absolute certainty? We know this is where the price hit its lowest point and started attracting buyers. But why was this a turning point? At that moment, there was a noticeable influx of buyers, meaning more money was coming in than going out, creating the pressure that began pushing the stock upwards. Now, why does this matter? And who are these buyers? In the stock market, we have $26 trillion in play, split between two main groups: retail investors, individuals managing their own accounts, and institutional investors, hedge funds, pension funds, big banks. The latter group holds the lion's share of trading power, responsible for over 90% of market volume. When we see big movements, it's almost always due to institutional money, not individual traders like you or me. But the beauty of being a retail investor is that we are agile. While institutions make waves, retail traders have the flexibility to slip in and out of positions quickly, gaining an edge by riding the momentum set by these large players. So let's look together at this piece of evidence. An article published by CNBC about Warren Buffett. It explains why he bought $10.7 billion of IBM stock. This article is from November 2011. And in short, it says that Warren Buffett has been buying IBM shares worth $10.7 billion since March 2011 and continued doing so. By the way, at this time, Warren Buffett's personal portfolio exceeded $165 billion. He's an institution in himself. Imagine that, $165 billion. If he takes a small percentage of his portfolio, say 10 billion, he moves the entire market. Institutions, when they use even the smallest portion of their portfolio, it's still an insane amount of money. Let's go back to the chart and find the area where Warren Buffett started buying, because this chart is actually the price chart of IBM. Warren Buffett started to buy in March. So the area we spotted is actually the area where Warren Buffett started to buy IBM stocks. Let's go back in time. Let's assume today is March 2011. There are a few questions Warren Buffett must answer first before he can go and buy IBM shares worth 10.7 billion US dollars. So, what are these questions? How many shares can he buy? Well, that's easy math. Buying 10.7 billion US dollars worth of IBM shares with an average price of roughly 160 US dollars, he can buy 67 million shares of IBM. Now, another question. Is that a little or a lot of money going into that stock? Can he buy all 67 million shares of IBM in one day? Well, based on the average daily volume that is traded on IBM, which is roughly 6 million shares per day, the answer is pretty obvious. It's a lot of money, and based upon the laws of supply and demand, if he were to place an order of 60 million shares all in one day to buy that stock, what would happen to the price of that stock based upon the laws of supply and demand? It would skyrocket. Not just a little, a lot. He would get a few million shares filled, and then the stock would end up mooning to $400 a share before he got the rest of his orders filled. Now, if he ends up buying his shares on the way to the top, a majority of the shares he will buy at much higher price. Is this good or bad for Warren Buffett? Of course it's bad, because his average share price would be much, much higher. Absurdly higher. So, should he put one order in? No, definitely not. Out of his own self-preservation and desires to make good returns, what will he have to do? The answer is scaling in. He'll scale in a little at a time. Can institutions buy everything they want to buy all at one moment in time? Yes or no? Based on what we have just discovered, no. So they have to buy a little here and then a little later and then again a little later. But on the other hand, can you and me buy all at one time? Yes, and that's where our advantage is. Remember, the article was only released in November and Warren Buffett started buying in March. So let's turn back time and go to March. Do we know at that time that Warren Buffett or any other institution is buying? No, we do not. But I tell you what we can see. We can see institutional footprints after the fact that they have bought. And knowing that institutions scale in over time, to get all their willing buy orders filled, we would simply look for those institutional footprints on the chart, and then we are going to buy when price comes back into those price areas. So we have absolutely no idea that somebody is buying in March. But later in May and definitely towards July and August, we could identify this area as a demand area, and only then we can look to buy when price is coming back, because we know that there are likely a lot of institutional unfilled orders left at that particular area. And if we buy here, we would be buying with an institution as opposed to with a retail trader. So, what have we established? Institutions control the price of our stocks and all other markets. They drive them up, they drive them down. Why? They have all the money. You and me, we can't move the price of this stuff. But we've got to make money from the stocks or any other market. If we buy a stock, we need it to go up. But who can drive it up? They can. And they will leave footprints in the market. Think of Warren Buffett as a serial killer. And likely any serial killer, they have the urge to leave breadcrumbs behind for us to find. What about selling? What about supply? Let's look at this article released on the 5th of May 2017. So roughly 6 years later, Warren Buffett has sold IBM shares and revalue tech icon downward, cites big strong competitors. This article summarizes how Warren Buffett sold a third of his shares in Q1 and Q2 2017. Now, in this area in red, what can you say about this area? Remember, Warren Buffett only sold a third of his shares, meaning he's got 2/3 left. So he would be a willing seller at these price levels of roughly $170 per share. We can say, with a lot of likelihood, that there are still a lot of hidden unfilled orders left here. More willing sellers, less willing buyers. This means there is an imbalance. In this case, it's a supply zone. Now here's the million-dollar question. If the price is going to come back up to $170 per share, would you want to buy IBM or would you want to be a seller of IBM? A seller, right? Let's move forward in time. It's now the 4th of May 2018, and there's another article now about Warren Buffett and IBM that summarizes how he has sold his remaining shares in Q1 2018. We also saw in the chart exactly what we were expecting. First, the imbalance, and as a result, a supply area was created. Here we would spot a lot of unfilled sell orders. What happens next? The price comes back into this area. The remaining unfilled orders are being filled and price is shooting to the downside. Again, how can we participate here? First, we don't know that he is selling back in April, but after the fact that he sold, we can see the institutional footprints on the chart, which Tobias will explain in module 2. And we want to be a seller right here in 2018. When the price comes back into our supply areas and finally price drops from our zone. Tobias will go into detail on the process on how to identify these areas with very high probability, basically translating the laws of supply and demand and unfilled orders to the price chart. Let's wrap it up. Who controls the market? Institutions. Can institutions buy all at once? No. They must scale in over time and require multiple transactions. Can we, you and me, buy all at once? Absolutely. We are very, very fast in the marketplace. Although nobody cares what we are doing. But we are really quick in the marketplace. Bottom line, if institutions are buying, you better be doing what? Buying. If institutions are selling, you better be doing what? Selling. Doing the same thing that they are doing. Market prices turn where supply and demand is out of balance. Meaning, one party becomes zero at the specific price or area. Therefore, a trader needs to identify in advance the price area where price becomes out of balance. Market turning points. This area of imbalance is where the trader can find unfilled orders from institutions. The bigger the imbalance, the higher the amount of unfilled orders. And our goal is to find the hidden institutional unfilled orders. We are now ready to dive into your first module. I will see you in your first lesson.